In 2008, the Bank of England published a quiet paper. It confirmed what most people still don't believe today. When you take out a loan, the bank doesn't lend you someone else's money. It creates new money, out of nothing, with a keystroke. And almost no one outside the system knows this is happening. You've been told to save money your entire life. But while you save, someone else is creating it, not printing it, not mining it, just typing it into existence. And the gap between those who understand this and those who don't, that gap is widening faster than most people can even measure. Right now, in 2025, global debt exceeds $300 trillion. That's not money that was saved and lent out. That's money that was created through the lending process itself. And every dollar of that debt represents someone's obligation to pay it back. This is the machine. And most people are fuel, not operators. Here's what you learned in school about how money works. You deposit money into a bank. The bank holds most of it. It lends out a small portion to someone else. That person spends it. It gets deposited again. The cycle continues. This is called fractional reserve banking. And it sounds reasonable, except it's not how the system actually works anymore. The textbook model makes it seem like banks are intermediaries, like they're just moving existing money around the economy. But that model is outdated, obsolete, and dangerously misleading, because it makes you think money is finite, that there's a fixed amount being circulated and recycled. And if that were true, saving would be powerful. But it's not true. And that changes everything. In 2014, the Bank of England published a paper called Money Creation in the Modern Economy. It stated clearly, when a bank makes a loan, it simultaneously creates a matching deposit in the borrower's account. No vault, no reserves, no pile of cash moving around. The bank simply creates the money when you sign the loan agreement. This isn't a conspiracy theory. It's how central banks describe their own system. The Federal Reserve, the ECB, the Bank of Japan, they all confirm this. And most people never hear about it. Because if they did, they'd start asking different questions. Questions about who benefits. Questions about power. Questions about control. You walk into a bank and ask for a $300,000 mortgage. The bank doesn't check if it has $300,000 sitting in a vault. It checks if you're creditworthy, if you can pay it back. If yes, it credits your account with $300,000. That money didn't exist 5 minutes ago. Now it does. You spend it on a house. The seller deposits it. It stays in the system. The bank now owns a claim on your future income for 30 years. And the money supply just expanded by $300,000. This happens thousands of times a day across every bank in the world. Mortgages, car loans, business loans, credit cards, each one creates new money, each one expands the supply, and each one creates a debt that must be repaid with interest. Banks can't create infinite money, but the constraints aren't what you think. They don't need deposits to lend. They need capital requirements. In the US, banks must hold around 10% capital against certain loans. So for every $100,000 in capital, they can create about $1 million in loans. That's a 10 times leverage on money creation. And when interest rates are low and asset prices are rising, banks lend more. Money supply grows, prices rise. This is why housing, stocks, and everything else feels more expensive. Because there's more money chasing the same amount of real things. The other constraint is confidence. If people stop believing they'll get paid back, they stop depositing money. If depositors panic and withdraw, banks face liquidity problems. This is why bank runs are so dangerous. Not because banks run out of money to lend, but because they can't convert all their loans back into cash instantly. The system runs on confidence, and confidence is fragile. Once you understand this, you see the world differently. Inflation isn't just too much money chasing too few goods. It's the inevitable result of a system that creates money through lending. Every mortgage, every car loan, every business loan, each one expands the money supply. And when people pay off loans, the money disappears. Principal payments destroy money. Interest payments go to the bank. This is why central banks panic during recessions. If lending stops, the money supply contracts. The system freezes. So they lower rates, they encourage borrowing, they keep the cycle going. In 2008, they went further. They created money directly through quantitative easing. They bought bonds and assets, injecting trillions into the system. Not to help you, to keep the banks lending. Because if banks stop lending, money creation stops. And if money creation stops, the entire system collapses. In 1989, Japan's asset bubble popped. Stock prices collapsed. Real estate crashed. Banks stopped lending. And because banks create money by lending, the money supply stalled. Businesses couldn't borrow. Consumers couldn't spend. Deflation set in. Japan spent the next 30 years trying to restart the lending engine. Zero interest rates, negative rates, quantitative easing. The Bank of Japan bought stocks, bonds, and real estate. They did everything they could to encourage borrowing. But when people and businesses are over-leveraged, they stop borrowing. And when they stop borrowing, money creation stops. This is the trap every central bank fears. It's why the Federal Reserve cut rates so aggressively in 2008 and 2020. It's why they'll tolerate inflation before they'll tolerate deflation. Deflation means debt becomes more expensive in real terms. It means defaults. It means bank failures. It means system collapse. So, they'll always choose to create more money, even if it means your savings lose value every year. Here's the part. Most people never connect. Banks create money when they lend. They profit from the interest. They're not taking risk with depositors' money. They're creating the loan itself. Meanwhile, you're working for money that already exists. You're competing for a share of the supply. And every time someone takes out a new loan, the supply expands. Your savings don't. Your salary doesn't automatically adjust. You're playing a game where the other side can create the points. And most people don't even know the scoreboard is rigged. Think about it. You work 40 hours a week. You trade your time, energy, and skill for money. Money that took you real effort to earn. But a bank can create that same amount with a keystroke. No effort, no time, just a credit-worthy borrower and a signed contract. This doesn't mean banks are evil. It means they operate by different rules. And if you don't understand those rules, you'll always be at a disadvantage. This is why the wealth gap keeps widening. It's not just about who earns more. It's about who understands how money is created and positioned accordingly. The wealthy don't just save money. They understand leverage, but not personal leverage, not consumer debt. They understand how to use other people's borrowing to their advantage. They own assets that appreciate as the money supply expands. Real estate, stocks, businesses, commodities. When banks create money through lending, prices rise. If you own assets, you benefit. If you only hold cash, you lose. This is the game, and most people are playing it backward. This isn't about anger, it's about clarity. Most people see money as scarce, limited, hard to get. And for them, it is. But people who understand the system see money as a tool. They see leverage, credit, and capital as mechanisms. They don't worship cash. They understand how it's created and controlled. And they position themselves accordingly. This isn't about becoming a bank. It's about seeing the game clearly, knowing that money isn't static. It's dynamic, controlled, expandable, and your relationship to it changes everything. When you see money as scarce, you hoard it. When you see money as abundant, you focus on value. Value is what matters. Money is just the measuring stick. And if the measuring stick keeps changing, you need to measure differently. Here's where most people get stuck. They know the system is rigged, but they still play by the old rules. They save in cash, they avoid all debt, they fear inflation, but they don't adjust their strategy. This is a subconscious conflict. Your conscious mind knows money is being created constantly, but your subconscious still treats it like it's 1950, when money was backed by gold, when saving actually worked. That world doesn't exist anymore, and until you update your internal operating system, you'll keep making decisions based on outdated assumptions. This is why mindset matters more than tactics. You can know the truth and still act like it's not true, because your identity hasn't shifted yet. Here's the paradox most people miss. In a system where money is created through debt, the person with no debt has asymmetric power. When everyone else is leveraged, you have optionality. When credit tightens, you can buy. When others panic, you're calm. This doesn't mean hoarding cash forever under a mattress. It means understanding that margin of safety beats leverage every time. The system rewards banks for creating money through loans, but it punishes individuals who overextend. Debt is the bank's advantage. Cash is yours. Cash gives you time. Time gives you clarity. Clarity gives you opportunity. When the system freezes, and it will, you want to be liquid. Not leveraged, not illiquid, not dependent on credit. This is sovereignty in a system designed for dependence. In 2008, Lehman Brothers collapsed. Credit markets froze. Suddenly, banks stopped lending. Money creation stopped. Asset prices crashed. Liquidity disappeared. The people who survived, those with cash and no debt. Warren Buffett deployed billions. He bought when no one else could. He made deals with Goldman Sachs, Bank of America, and General Electric, terms that would never be available in normal times. Meanwhile, over-leveraged investors lost everything. Hedge funds collapsed. Pension funds imploded. Fortunes evaporated. Same market, same crisis, completely different outcomes. This wasn't luck, it was positioning. And positioning comes from understanding how money is actually created. Buffett wasn't smarter than everyone else. He just understood the system better. He knew credit would freeze. He knew liquidity would vanish. And he made sure he had cash when no one else did. You don't need to become a banker. You need to understand the difference between income and wealth. Income is what you earn. Wealth is what you keep and control. In a system that creates money through lending, the people who benefit most are those who understand the flow. They don't take on consumer debt. They don't confuse leverage with wealth. They build cash, they wait, they move when others can't. This is sovereignty in a system designed for dependence. Start here. Eliminate all consumer debt. Credit cards, car loans, personal loans, all of it. Not because debt is immoral, because it puts you at a structural disadvantage. The bank created that money, you have to work to pay it back. That's an asymmetric trade. You lose by default. Once you're debt-free, build cash. Not forever, not as the end goal, but as a foundation. Cash gives you optionality in a system that runs on credit. When credit tightens, opportunities appear. When everyone else is leveraged, you can move. Then and only then do you start thinking about assets. Assets that hold value as the money supply expands. Assets that generate income. Assets that compound. But always with margin of safety. Always with control. Never betting everything on one position. This is how you build wealth in a system designed to extract it. Money creation isn't evil. It's a mechanism. But like any mechanism, it has winners and losers. The winners understand how it works. They see money as a tool, not a scorecard. They build margin of safety, not leverage. They think in decades, not quarters. And they never forget. The system creates money through loans, which means the borrower is always at a disadvantage. This isn't about cynicism. It's about clarity. The system isn't going to change, but your relationship to it can. If you take one thing from this, let it be this. Money is not scarce. It's created constantly. But your time, attention, and freedom, those are finite. Don't trade what's finite for what's infinite. Build cash, eliminate debt, control your time. Understand the system, but don't let it control you. This is how you win a game. Most people don't know they're playing. And once you see it, you can't unsee it. Every loan, every credit card offer, every mortgage ad, you'll see it for what it is. An invitation to become the fuel, not the operator. Choose differently. If this changed how you see money, subscribe. We're building a library of clarity. Every week, we break down the systems that shape your life. Money, debt, incentives, psychology. And for those who want to go deeper, join us on Patreon for frameworks, case studies, and mastery content. This is Luxona, where clarity builds wealth. Welcome.